Huge rise and comebacks when the world economy almost went down. That's what people remember about Tesla. Whether you're in the long-run investments or the short-term flips, it's hard to overlook the perceived potential of this major player swimming in the exciting waters of Nasdaq. Whether you love, hate, or doubt it, Tesla remains one of the biggest names in the financial market and the mainstream. Very few were able to imitate its comeback, its success, despite all the doubts back in 2019 and prior, and it convinced the market at large that a company making expensive cars with highly polluting metal is the answer of all our environmental problems. And yet, it has succeeded doing so, or at least succeeded convincing the market that that's the solution and created one of the biggest bullish surge in recent memory. Nevertheless, the uncertainties around currencies, inflation, political and geopolitical instabilities have blurred the market's capacity to remain optimistic, and while waiting for EVs to save the world, many are simply hoping that the market will save Tesla. Over the past few years, if there were anything that has significantly altered our perception of reality and shaking up our assumptions, few things have really done more damage than the change in the labor market and the inflation. Many people lost their source of income, others are now fearing losing theirs after seeing their once flourishing companies overhiring during the pandemic, then having to double down the other way to compensate for their mistakes or to overcompensate for their past mistakes. Millions of people are now navigating the uncertainties of disappearing labor demand as well as the spike in inflation. Stay-at-home policies were not cheap, and at the end of the day, the collective had to foot the bill no matter how evenly it has to be done. So simply put, money is harder to be made, and even for those who have any, it's quickly losing its value. Taking our affairs into our own hands should be the first step towards our financial freedom, and finding the golden goose has been the quest of many. Tesla definitely is one of the stocks that should remain on top of most people's shortlist and on most people's mind. Not only to profit from it, from like the price fluctuations, but to read the bigger picture through its movements. In this video, we're going to take a deep dive into Tesla and to see what's the best course of action given the current circumstances. Before the video continues, I just want to take a moment to thank you for coming to my channel and hope that you can enjoy your stay and to come back for more content. If you like what you see, please consider to like, subscribe, and to check out my channel for playlists of the companies I cover. With that being said, I hope you're going to enjoy today's video, and let's get started. Over the past few days, Tesla has been priced at around $187 to $190, which remains mostly consistent or even slightly bullish, considering its previous price actions trends. There were lots of ups and downs following multiple splits that Tesla had over the past few years, which were also its most glorious ones by far. The market suddenly discovered, or pretended to discover, the potentials of a previously niche sector. There are lots of reasons to explain why Tesla is having a challenging time as of late. The market has been expecting ever more positive catalysts when what the company was releasing, has been mixed signals. The global markets entered into recession and uncertainties, at least de facto ones, when cars are only needed when there are peace and stability. Rare earth are being qualified as highly toxic and challenging to extract, not to mention the human rights concerns for their countries of origins. EVs are still too highly priced for mass adoptions, especially when there are cheaper hybrid cars, or even amongst the EVs, cheaper brands from traditional manufacturers. There may be more subtle reasons as well, such as the influence or, the bad influence of Elon Musk, the macroeconomic cycles, the shift of narratives that we're going to discuss later as well. Many of those reasons may explain why Tesla has been often sold off when it's near like the $200 psychological level, when its relatively high baseline is seen as ripe for the taking by those who would prefer to safeguard their capital. When there are enough of them, it's only a matter of time before most of them decide to pull out their money. Exactly like when the same ones flocked in 4 years ago to preserve their capital when the world economy nearly came to a full stop. What the current price action is telling us is that Tesla is going through a moment of consolidation of many years of after many years of high growth. The previous catalysts may have worn out and the new ones have yet to come. The future outlook of the company may require more positive aspects before more capital rushes in. The financial data released by Tesla on a quarter and annual basis are of significant importance for the outlook and the stock price, but given the characteristics of Tesla, the company doesn't only depend on numbers, but images and thoughts. So with that being said, they serve as a safeguard of the existing baseline, and over the past few quarters, things could have been better. Despite having a net profit, which was the main reason why Tesla became such a highly valued company to begin with, its profit margin and cash flow figures were all getting worse on a year-to-year basis. Profitability is probably the most significant financial figure that may influence Tesla's price action because it has a symbolic meaning that goes well beyond the company's scope. Because Tesla is such a large company, its well-being does carry weight for the rest of the sector. If Tesla makes money, that will often be viewed as representative of how the EV sector is doing. The rest of the market will probably follow Tesla in both share price, outlook, and sometimes even profitability. The other element to watch is the growth. Since it's currently one of the most highly valued companies in the world, the ratio of profit to its equity price is certainly much higher than most other companies. People come for Tesla's potential to grow exponentially in the future still. So, in a way, those pouring in money into Tesla are buying the Tesla to become, not the Tesla that already is. This is why any decrease, not only of the current profitability, but of the growth rates, will always affect the market cap. The financial figures for Tesla will always have a significant degree of importance, if not to predict the future, then at least to justify its current share cost. For a stock that lives off momentums, we still need more than just decent financial results to justify the share's existing and future bullishness. Of course, most people interested in Tesla would not be making any decision based on the financial statements, but the evolution of the market dynamics. In other words, most of us buying Tesla are not expecting to get rich on its dividends, but the quick appreciation or the big swings of the share price. We want to buy into the success story and to keep trending off the ongoing narratives of the energy transition, alternative mobility solutions, and what have you, like the domination of technology over industry, or at least the domination of the valuation formulas of technology over industry. The appeal of those narratives may be the advancement of technological capacities, but also the different formula to calculate market caps depending on their classification by the market. Tesla began with a bold statement about zero-emission vehicles, and for many years the market has been skeptical about the feasibility of its mission. It got to a point where the company was about to get sold, or at least trying to, without much success, before the break-even point has finally been reached, and the surge in its popularity as the world economy came to a halt in 2020 quickly erased those past stories in people's minds. It also happened around the same time when many countries around the world decided to ban the sales or announced to ban the sales of new combustion engine vehicles after a certain time frame, especially in the northern hemisphere. This mentality has been able to establish itself in the investment and trading community over the next couple of years, as simple mentions of EV can bring you billions of investments. People were not investing, they were fleeing into glittering life pods. Market being a self-fulfilling prophecy with simple math behind supplies and demands, or at least that's so for most of the times. The share price of Tesla reflects the optimism at the time, which was absolute to the fullest extent. In fact, even when the market started to doubt about the relevance of the sector in the long run, when there are more investment options to safely park your money into, even when an increasing number of people talk about it like an industrial chain instead of a Silicon Valley maverick, Tesla does benefit from a more indulgent, patient fan base with deeper pockets. What this means is that while other brands like Rivian, Nikola, Fisker, Molin, or Lucid have all collapsed or faded away under the weight of time, Tesla is simply having a relative sell-off. So for me, this is a very important appeal of Tesla because it shows that it has enough gravity of its own to hold on to its accumulated gains over the years, instead of melting like snow for many other companies who wish to challenge its supremacy. So simply put, Tesla is indeed a major player in the sector that has the capacity to absorb almost all the glories and, of course, most of the backfires, but has enough demand to maintain a fairly high baseline below which many people would prefer not to short sell, because of the potential losses being unlimited and the likelihood of short squeeze being slightly higher than average due to its status. But of course, there's going to be also another issue, which is the shift of narratives. What if EV is no longer cool to talk about in a decade? Just like the fintech has been cool to talk about, just like the sport gambling websites were the darlings of the 2020s. What if one day people no longer see Tesla as a statement, but more just as a tool, just like any other car? It's a bit like saying, if you buy a bottle of Voss, it's not really because you're thirsty, it's because you want to make a statement. Well, it's kind of the same thing with Tesla, right? If you buy a Tesla, what you tell the world is that what you need is not like a vehicle, it's not a mobility solution. You want to show to the world that you own a Tesla. That's what I personally view, or that's what I personally see. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, having said all this, my opinion about Tesla is that right now things are still looking kind of iffy in terms of bullishness. Because if we want to go in, we want to be sure that, right now, like the current pullback phase is ending. We're seeing that it's slowing, that it's accumulating near the current level. So I would say between like 190 to 200, there's going to be some sort of choppiness going on. But nobody knows for sure if Tesla will have the capacity to make a comeback back to its former glories. Because it kind of also depends on where Elon is going to bring this company towards, right? If every single time you think about this whole company, you think that it's quite a mess. You think that he should never have bought Twitter. If you think that it's like $50 something billion payout is wrong and so on. I'm not saying that it is right or wrong. I'm just saying if people think that way, then it's only a matter of time before things turn pretty sour. So I would say that going in, you must be someone who trusts the EV sector, meaning you're not like you believe that this sector is going to flourish, that hydrogen is not going to replace it, that combustion engines are actually going to phase out by like 2030. If you believe that kind of stuff and you want to have some sort of exposure into EV cars, then yes, Tesla is a good choice. In fact, it's probably the place to start. It has proven that it's like the safest option out there for this particular sector. And other than that, I would say that it's now a good time for entrance. It's a good time to start to accumulate. Like if you believe that it's a good choice for your portfolio, if you understand that nothing is guaranteed, not even EVs taking over the world scenario. So If all of these apply, then yes, Tesla is a smart choice, and yes, owning it now would be a decent choice as well. The maximum exposure I would personally recommend would be between 8 to 10% of your portfolio.